Hello, everyone. Welcome to our Investor Roundtable. Today, we are going to talk about the Maysville, Kentucky acquisition and just our industrial acquisitions in general. We have a lot of them coming up here over the next few months, including the Maysville acquisition, which we fully subscribed to yesterday in less than 24 hours. We're really excited to talk about the Maysville acquisition deal in addition to a few other deals we have coming in the pipeline and just generally how we're looking at these deals in the pipeline and what we're looking for our investors to maximize value.
So a little bit about F Street here in case you're new to the webinar roundtable series. So F Street is an alternative real estate investment company. We are focused on creating shareholder value and building long-term wealth for our investor base through passive streams of income through our real estate investments. And what we try to focus on is planting money trees. So providing liquidity back to our investors, getting diversification through our platform through many different industrial acquisitions that Nick and I are going to highlight today, as well as some of the multifamily deals that we work on the development and acquisition side. So thanks for your time today.
Yeah, thank you.
A little bit about the industrial portfolio. As I mentioned, F Street is solely laser focused on creating value through two asset classes, industrial being one of them and multifamily. Because we're highlighting our industrial acquisitions platform, wanted to show a quick slide on our industrial portfolio, which consists of industrial developments and acquisitions. You can see projects in Wisconsin, Indiana, Minnesota that we've developed and purchased. We purchased a deal in Indiana in December of 2024. And the deal that we're talking about today, which we just closed the equity in under 48 hours, is in Kentucky. So the platform is nationwide, and we continue to seek to buy opportunistic real estate in the industrial space to create value for our shareholders.
Yeah, absolutely. So again, I'm Nick Young. I'm Director of Development.
Josh Lurie, General Counsel and VP of Investor Relations.
So again, talking about specifically into the deals we're looking for. As Josh mentioned, multifamily and industrial are really our focuses here in early 2025. Right now, from the industrial standpoint, which is why we're really talking about this with the Maysville acquisition and raise, in addition to the acquisition we did back in December and a few others we'll have over the next few months here, what we're looking for. Deal traits, what we think is going to be good for our investors, finding that assets that fit that mold to benefit our investors that we think are really of great value right now. Industrial assets, I think, are trading at a really good value, at least from a cap rate and a long-term perspective about what tenants are looking for, what the new administration's bringing in from a political standpoint on focusing in the United States, focusing on that investment for that manufacturing and logistics. So typically what we're looking for is assets built before 2000. Really, you're seeing that value, call it second gen, 100,000 plus square feet. We are looking at buildings a little bit lower, but that's really our ideal size in areas where we have submarkets of sub 2%. With those, we can really utilize a few areas. One is tenant in place cash flow. Day one cash flow, we can see our investors return on their dollars the day we close. Using December as an example, on the Indiana acquisition, we made a distribution within the first week, just based on timing, and then we've continued those distributions with the next distribution coming in the next week here. So on top of that, really we see a lot of mark-to-market rents. Using the Indiana deal again as an example, the current tenant in place has below market rents. They have about 4 years left on their lease. Whether or not they extend, we'll either mark them to market, blend and extend, or if we find a new tenant, we're either able to undercut the market and increase the rents and create more value for our investors. So that's really one of the great ways we see value in these assets.
Yeah, and Nick, when we're looking at these opportunities collectively as a team, I know you mentioned that mark-to-market thesis, right? Another thing that we look at, which we're focused on here, is buying assets at a low basis, right? Significantly below replacement cost, right? And that allows us to achieve and undercut the market. So we can undercut the market from rents. We can still achieve a mark-to-market. And what that does is it increases our net operating income, right? And that, as a function, it projects a different value on the asset, right? So we take some calculated risk here internally. We buy some of that risk with some maybe expiring lease term in 3 to 4 years. And maybe we have that opportunity in 2, 3, 4 years to create that value, right? To achieve those mark-to-market rents. And what that does is increase cash flow for our investors, but it also increases building value and builds additional equity in that asset. So we're solely focused on finding these opportunities, right? With lower under replacement costs to build the asset, right? Undercutting the market in terms of finding that tenant that doesn't want to pay $7, $8, $9 a foot on new construction, right? But they're more than capable of paying $4 to $5 per square foot in these types of assets. And as Nick mentioned in the physical asset section, when we're buying these assets under 2,000, there might be some work that needs to be done, right? We might have to do some touch up on the on the roof or the parking lot, right? And we're prepared in our upfront sources and uses of capital, right? Through our due diligence, we know the scope of work that we have to do to get this asset back to a 2010 or 2020 vintage, right? So we're creating that value on the building, right, on the physical structure, but also from the lease nature, we're able to then achieve that additional income through the backfill or through the mark-to-market rents.
Absolutely. And that's really the goal, is how do we create that value in the buildings? How do we create the value for our investors and for our long-term thesis of growing money trees, as we've talked about?
Absolutely.
Talking about that piece of it too, I mean, all of the assets we're looking at, to build a new asset over 100,000, call it 100,000 square feet, you're talking about building a building over $100 a square foot. And we're talking about buying buildings that are in the $30 to $50 per square foot range, some slightly higher depending on the tenant, which gets into tenant creditworthiness. That's always a large piece of it, is creditworthiness of the tenants, their ability to pay, whether they're institutional grade tenant, whether they're rated, whether they're publicly traded. That's always a large piece of it too. But again, where we can find value. Using Maysville as the example, the one we just filled, it is a nonprofit, but it's a nonprofit. It's the 5th largest nonprofit in the United States by revenue. They have over $3 billion of revenue, and that looks to continue for their business. And this being critical to their operations shows you, we call it the stickiness of the tenant. We'll always use that word when it comes to industrial assets, a sticky tenant, because they're interested in long term. We're interested in investing in them, and they're interested in investing in the property.
Right, and that's one attribute that we really look at, right? Some of these manufacturing companies are a good 360. We look at their capital expenditures over the last 3 to 5 years to show their commitment to the space, right? Here, they've hired new employees, they've invested money in their building, their own money, and that shows that they're strategically positioned in this asset, and they want to continue to grow in this asset, which is not maybe in the lease structure right now, meaning they might want to be here for the next 30 years, but we don't have the documentation for that, right? We have the lease in place and they have an option to renew, but we're confident in their business. We're confident in the location and why it fits their strategic needs. And we believe, or with a high probability believe, that they will be in this building for a lot longer than their current contract in the lease that we've assumed, or that we will assume when we close on the deal in March.
Yeah, absolutely. So again, just diving into that deal a little bit. So we started a little bit, how it checks our boxes. One, the physical asset, 153, call it 154,000 square feet, 23-foot clear throughout. It's a great building. Docks, bays are all on one side. That's always a critical piece of it. 17 docks on a building this size is a large amount, great for logistics, which is what Good 360 is using it for. For us, cash flow. Very strong lease structure for the tenant, for us. They have an option. For us, that's good. That shows their long-term commitment, their capital they've put into the building, as Josh alluded to earlier. And they've said they've hired 75 employees in the Maysville area. So again, showing commitment to community, to the development, and then for our investors in the long term, that cash return. We've projected a cash return here I'll kind of give projected a cash return for our investors on this. This will change slightly as we finalize our debt financing. We'll likely have a first year of interest only, which is likely going to increase the distributable cash flow to our investors and likely put that first year in the 11 to 12% range. We'll have, depending on the debt, whether we fix it or float it, these numbers will change slightly, but these are roughly consistent with what we're looking at from this asset's perspective.
Right. Good projected baseline returns right there.
Right. And talk about our typical investment structure.
So can you go back for 1 second? I just want to mention one other thing, Nick. One thing we also look at is, Nick and I've kind of mentioned some attributes in terms of what we're looking for, what we're seeking, and what we do during due diligence. We always obviously scrub the leases, right? Because that lease, right, that we're assuming is our contract in place for cash flow, right? So as you see in the second section, right, built in that lease structure, and not all leases have that 3% annual rent bump, right? To keep up with inflation, that's critical. We review leases sometimes, and there's no rent increases, right?
Right.
Because that prior seller negotiated a lease, and for whatever reason, 3, 5, 10 years ago, wasn't able to successfully negotiate rent bumps. So we see that oftentimes, which can be problematic, right? So here we like that there's, cost of inflation bumps or modest bumps at 3%, and that provides, inherent increases of cash flow for our investors, right? So just wanted to quickly mention that.
Yeah, and that's a good point. Is we always do a big dive into these leases. Leases are critical. Josh and I are both attorneys. We utilize outside counsel as well on a lot of projects. So that's always a critical piece of it is analyzing that piece. Here again, we're triple net lease on this project.
Right.
We typically look for triple nets. We also find that there can be value in gross leases
Absolutely.
because a lot of buyers won't be interested in that because it's not triple net. But then we do the due diligence, see what those costs are that we might need to put into the building or covering some of those operating expenses that can create more value for our investors and for the building.
Absolutely. And we also, Nick and I, will scrub these leases to ensure that the operating and maintenance and expense provisions in the lease, as well as some of the landlord and tenant responsibilities. The reason why those are so critical is because those impact cash flow, right? So depending on who's responsible for these certain items, that affects our ability to reserve with our financial team certain dollars, where if we don't have to do that, that produces more cash flow for the investors, right? So the lease structure and the lease that we're assuming is super critical as part of our overall diligence, no different than the actual physical asset and us flying out there and doing all the things that we do with the physical asset. The actual lease on paper is extremely critical too, and people don't always aren't super careful to scrub that.
Yeah, absolutely. So I also do want to mention we are live. So if anybody has questions, please ask it. We always look at these as an open forum. We just seen everybody on here. If you have questions or if you want to ask more details, we're here for you and to answer any questions.
Definitely.
Talking about the general investment structure, using Maysville as an example, this is our typical structure on how we look at industrial acquisitions. Of course, each deal is different, but using the most recent example, how this investment structure works is all of our investors receive a 7% preferred return. You own equity in this deal. How we structure it is there's two classes, an A and a B share. The A investors are our investors, our LP investors or us co-investing in the deal. Own 50% of all the units, and then F Street owns 50% of the other units, the Class B units. That being said, how it works is anybody that invests, say you invest $100,000, that is earning a 7% preferred return on outstanding capital at all times. And then after paying back the 7%, any dollars first go to paying back your capital. So that 50-50 split doesn't come until 100%
Absolutely.
of the preferred return and the capital's returned.
And that's a unique feature, Nick, wouldn't you? I mean, a lot of firms will take a piece of the cash flow during that process. F Street does not earn $1 until investors have received 7% preferred return on their outstanding capital and 100% of their principal investment before the split happens at 50-50. So we're motivated and aligned to return your capital back. The only way we can do that efficiently is to create value, produce cash flow to return your 7% preferred return and your capital, but also create some liquidity through a refinance or a sale to ensure that we're delivering returns to the investors. And then obviously we would partake in that at the end of the day once investors have all of their capital back.
Exactly. And we call it, again, this is where money trees comes in, because you are owning a piece of the real estate. You're owning a piece of the entity that owns the real estate. And once we return 100% of that capital, and you see this is 100% back and we're doing 50-50 splits, you're still receiving that money. So even with 100% of your money back and that 7% preferred return, all that distributable cash flow is still paid out based on your unit ownership in that remaining 15%.
Absolutely. Yeah, and just a really, really brief example on a live deal, just to quickly illustrate what that looked like on a prior industrial deal. We developed a project in 2021 and built the project. We stabilized it through 3 leases on a 220,000 square foot building. Within 12 to 13 months, we had 100% of the building leased, and we're able to do a refinance based on the new value that we created based on in-place income through our net operating income. And what we were able to do is achieve a spread or about $8 million value over costs. So what we did with long-term leases in place, we put permanent debt on it at sub 4% at that time. And returned 100% of that preferred return that you see on $3.1 million plus 100% of the $3.1 million. And now that all investors had their capital back, we returned it to them. They're still, for every $100,000 invested, are receiving about $10,000 annually, roughly. Those leases also have annual rent escalators, and they'll continue to increase their cash flow as we hold the asset until we go to a sale. So that's just a quick illustration. Every deal doesn't happen exactly the same. It's a function of timing, lease up rates, underwriting pro forma versus actually hitting those numbers through leases. But we do a careful job of underwriting and doing our due diligence to make sure that we can be successful on these opportunities. So. Great question.
It's a great question. So the question is, how long does F Street go from finding a deal to closing it? Honestly, there is no exact answer. Using these acquisition deals as an example. So when we're fielding these deals, we work with brokers throughout the U.S. We work out through relationships, and finding a deal, whether it's on market or off market, can take anywhere from a day where it's on the market. We see it, underwrite it really fast. We have a great team of analysts between myself, Josh, Lane, Brian, and the rest of the team that do a great job of very quickly analyzing deals, which is what we pride ourselves on. It can be a day, and then we have maybe call it a 45 to 60 day diligence window where we can visit the site, underwrite it, do our due diligence, and then 30 days to close. So it can be as quick as, call it 60 to 90 days. Other deals we've been working on for years.
Right.
I mean, we keep these relationships going. We know a seller, or we know a municipality that's been trying to get this site working. So it could be anywhere from 6 months to a year to even just to get that deal to a position where it can be acquired or developed.
Yep.
And then, of course, negotiating large pieces of that. So there isn't
it's not a hard and fast rule. Yeah, just say, and that's just to add a little bit more color. I mean, sometimes we'll negotiate LOIs with our brokers and their brokers and the seller for 1 to 2 months, right? Or it could take 3 days, and there's an opportunity and the seller needs to sell. And then we move from an LOI negotiation to a PSA. And that PSA negotiation, when we engage Nick and me and their attorneys, that could take another 1 week or 4 weeks, right? Depending on the pace of their attorney. So ultimately, once we put under contract, that's the trigger for, as Nick mentioned, the 30 to 60 day due diligence, and then 30 days to close. So traditionally, we're working on these deals, and we have some knowledge that we're going to be having them under contract, and then working through our due diligence, that equity in standard course of business.
Yeah, 100%.
You want to talk about the
good question. So going specifically on the Maysville deal.
Yep.
Oh, sorry. The question again was, what is the bank loan, and is there concerns about changes in interest rates, and how long is it? Great question. So on the Maysville deal specifically, we just sent out to a few lenders. We have a lender we will very, very likely be going with that we've asked to order an appraisal to make sure we can close on time and quickly. Because for us, closing this asset sooner, assuming it pencils out in our due diligence from inspection, we want to move faster to closing time. The deal we're penciling out now, it would be a 2-year loan, first year interest only, and then the option to extend it. That piece of it as well, it's the interest rate is, we're still deciding if we want to float or fix. The fixed rate right now is obviously higher than the fixed rate because treasury yields are higher than SOFR index.
The floating rate is higher than the fixed rate.
Floating rate is lower than the fixed rate.
Right.
Because the pricing of treasury yields, for example, the 10-year treasury right now and the 5-year are at approximately 4.6, 4.7. versus the SOFR index is only at 4.3. So for us, we're always analyzing that. It's always a push and pull game. We conservatively underwrote this deal at over a 7% interest rate. Right now, it's looking like we'll be in the mid to high 6s, with the Fed doing a potential rate drop of 25 basis points twice in 2025. That would mean if we float, it'll likely go down. That being said, I'm not overly concerned about a large rate increase. I think we'll see some stabilization with the new administration. That being said, if we do start to see increase, just based on the yield we're buying this asset at, even if rates went up, call it 50 basis points, that won't have a significant impact on a deal like this.
Right. Yeah, so we're at the end of the day, we're finalizing the term sheet and whether we want to fix or float. Floating, obviously, as Nick mentioned, will reduce our rate if rates come down. We don't know that. We don't have the crystal ball. So we're also considering hedging that potential risk or uncertainty and fixing the rate. But regardless, we're under pro forma rate that we mapped out the deal before we received the term sheet. So we feel good about our execution.
Yeah, it's a great question. So part of that, which comes to what I mentioned, we'll likely do an interest only for the first year. Allows us to distribute more cash flow to our investors. That would increase that, those first year returns will likely increase. And then the refinance proceeds would change because we're assuming we're going to refinance in sometime in year 3. It's part of the strategy on this project as well, is working with the tenant on extending or executing their option earlier, or just having a conversation with them about their long-term plans, if they need any capital improvements, whether we need to make capital improvements. So that's part of it on this project, where we really wanted to project out into that 2 to 3 year period as well, so we can potentially refinance, get more proceeds for our investors, and then be more stabilized long-term cash flow.
Absolutely. So pipeline of opportunities, as Nick and I mentioned, our team here every day is diligently, looking at assets, talking to brokers and relationships, and seeking off-market opportunities that meet our investment criteria here. Our deal focus, obviously, we can go across the Midwest or nationwide. It's really chasing the opportunity and being opportunistic. So as long as these meet the criteria, meaning low basis, good bones of the building, 100,000+ square feet, with either existing stable tenants or a robust industrial market activity with low vacancy, and some mark-to-market rental upside or some ability to create value from a lease structure, whether we're buying a gross lease and converting it to triple net on a backfill. There's many different ways that we can create value. And here's a list of states that I guess we're targeting, I would say, but it doesn't mean that we're solely focused on those states.
Right. I mean, this list is actually, we're looking all over the United States. We have a few areas we don't love as much, but again, there's certain areas you can still create value. You can create value anywhere. This specific list are states we currently have either active LOIs or purchase agreements on. We did just sign another purchase agreement this morning for a property in Arizona. We're finalizing a few others in Michigan, Indiana, and Illinois, and then of course a few here in Wisconsin as well that we're offering on, that we see good value in. So every day we're looking at properties, making offers, working with tenants, working with sellers. So it's continued balance, and we just try to find those opportunities that look great for our investors.
Yeah, it's interesting. We do our own underwriting and establish a maximum price that we're willing to pay that meets our investment criteria. Oftentimes we'll write an LOI and submit it, and we're fine to walk away. We've seen, as we are disciplined and hold to our guns and our pricing and our terms through the LOI negotiations, sellers might walk, but then sellers might come back to us, right, and meet us at our pricing. So we have to stay patient. We have to stay disciplined. We don't want to chase opportunities. You can never retrade your basis, right? So the basis is super important for us, but also the activity in the marketplace and our ability to attract tenants to this building, where we're undercutting the market or we're very competitive in that market, is a huge opportunity for us. And we're excited about some of these additional opportunities that we're bringing to the market to our investors in the next, call it 1 to 6 months.
Yeah, absolutely. So again, want to say thank you again for joining us. Leave it open if there's any additional questions. We'll give it a minute here. Otherwise, again, thank you for joining us. If you have more questions, feel free to reach out to Josh or myself, or visit us at fstreet.com.
Yeah, thank you everyone for your time. We appreciate you joining us today and taking time out of your day. We are always available, so thank you.